Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Awful lot happening in markets at the moment. We saw some economic data out of the US yesterday that everyone took as strong data. However, the services PMI was still 20% off where it was in terms of activity only 9 months ago. And also the employment component was actually in clear contraction territory. So whilst the headline number looked good, it was up on the month, it was still expansionary. It wasn't an entirely bullish scenario there. And then we had US factory orders up 2%, which everyone was excited about, but they were only dragged up by a 6% gain in petroleum and coal goods factory orders. So not so much the perfect factory order number that many thought it was. We also had a Fed president coming out and saying that he felt the US economy was not in recession because of its firm employment. So basically there's only one economic criteria that is holding up well at the moment in terms of the US economy, and that's the employment level. But again, this is in a very entirely different kind of environment where there's been mass resignation, etc. And that's a big reason for the unemployment rate being lower, is that a lot of people have removed themselves from the general workplace in some part to retire, lifestyle choices, but also to start their own businesses, which is obviously a booming industry around the world at the moment. And it just makes you wonder how many little businesses can survive all competing with each other. But the race is on, clearly. So what I'm saying and suggesting is the US economy, in my book, I did forecast a year ago the US economy would be in recession this year. Even 3 months ago, people like Goldman Sachs, etc., didn't expect a recession this year, or most of the market didn't. They thought it'd be in 2024, and we got that right. But now that we're here with the recession, people are trying to find excuses not to accept that is the case. But it is. Purely technically, I guess, economically, but I think on the ground we are seeing consumer retrenchment. We know consumer and business confidence levels are at all-time lows or thereabouts. I mean, in the Michigan Consumer Sentiment Index, they are at all-time lows on that data series, which has been running since the 1950s, so that's rather significant. We're seeing a rolling over in the housing industry, the construction industry, manufacturing, but the services PMI had that little bounce. So I don't think it's all that much cause for celebration, though the market is looking for any excuse to rally at the moment. I mean, if the economic data is poor, the market rallies because it means the Fed won't hike. If the economic data is good, the market rallies because the economic data is good. Let's not worry about the the Federal Reserve side of things in that case. So the market sentiment is extremely bullish, which is why you're seeing these rallies, regardless really of what's happening in the economic data. And also you've got to remember that sometimes markets are only doing what they're doing because massive hedge funds or superannuation funds, etc., are building their portfolios. So in other words, they don't really mind what the data is on the day. They're going to be buying anyway. So sometimes we get a little bit carried away in thinking that any movement on any particular day is solely the function of what the economic data or Fed president said. It's really about often capital flows in and out of the market that we are simply not privy to in real time. So that's why, for instance, in the financial media, generally speaking, the headlines and the stories and the explanations of market behavior tend to follow the real market movement rather than preempt it. Which brings us to, obviously, the key point. What do we do from here? I've been a stubborn bear. I've been trying to sell rallies in the equity market, particularly in the US, way too early. Do I give up on that? Throw in the towel if you're in the same boat as me. Do we give up on that? Do we throw in the towel, or do we try again? I am going to try again, but very cautiously, smaller and smaller positions, and until we start to get the price action running our way. If you've only been trading in a pure price action perspective, using range breaks, technical analysis, momentum indicators, those sorts of things, you should be doing very well in this market. My hat is off to you. I would suggest to you, though, there are major forces at work here in the background, and those fundamental economic forces spell doom and gloom, actually. Does that mean the market will fall? Well, we saw economies come to an almost complete standstill during COVID, and the equity market still rallied. That's the number one primary reason why the bulls are so active at the moment. Recent history only 2 years ago, or the previous 2 years, in fact, relentlessly proved that despite reduced economic activity, equity markets could rally. At the moment, we again have an inverted yield curve in the US bond market, rate market, and that is sounding a warning of ongoing recession in the United States. I think the recession in the United States is only just beginning. We're only in the early stages of it and has a lot further to run. That doesn't mean we will see a negative growth number every quarter over the next 4 quarters, but I think the next 4 to 8 quarters of growth in the US will largely be flat, a little bit of negative, a little bit of positive from time to time, but largely flat. That is not supportive of corporate earnings. Speaking of which, everyone's very excited that earnings have exceeded forecasts, but by their nature, they will, because directors of companies can get into trouble if they've been overly enthusiastic about their expectations and their forecasts, their public forecasts. So they always err on the side of caution. They understate what they really expected. So therefore, just coming in as the directors privately thought would be the case means they've exceeded their earnings expectations and the stock should be bought. So there's a little bit of a game around that, but also there is brinkmanship in terms of directors do not want to be seen to have misled anyone, so they are very cautious when they publish those forecasts, and that's why earnings will nearly always exceed expectations. It was the forward guidance in all of this reporting season that was indeed troublesome and worrying. And we've even seen Walmart begin to lay off staff from its executive levels in the last 24 hours. That's not a good sign or a good indication that all is well in the US economy. So nice little headline numbers on the economic data in the US yesterday, but not really compelling, turn everything around. This is a strong economy stuff by a long stretch. Also, the Fed has made it abundantly clear that even if there is economic pain, it will continue to hike rates aggressively until it beats the inflation. Its inflation target, by the way, is 2%. US inflation is currently 9.1%. So how high will rates go? They could even go to 4.5%. So there's a lot of upside yet, a lot of economic pain to come out of mortgage stress, business loan stress, and more of that throughout the US economy, on top of still high food and energy prices. So you've got to remember, if those price levels flatten out, they're still very burdensome where they are to the average American family, and that's a similar story around the world at the moment. So the global economy, the US economy, by no means out of the woods, because we had some sort of nice feeling headline numbers there. I hope this helps you. All the best. All I'm suggesting is be a little bit cautious of the rally on economic grounds. On price action grounds, watch for a peak, watch for a reversal, watch for peak divergence in your RSIs, things like that. Any indication that the recent rally was stalling and falling back in on itself, pay close attention. Thanks very much for listening. Clifford Bennett, Chief Economist, ACY Securities.